You need to hear this one fact. Meta Platforms, the company that used to be just Facebook, is committing to one of the largest private capital expenditures in history. Over $600 billion by 2028 to build the AI infrastructure of the future. This isn't just a big number. It's a visionary Henry Ford-style commitment. Some investors sold off the stock 17% after Meta announced the increased spending. They see wasteful spending. But the question we need to answer is this. Is this volatility a massive buying opportunity, or is it a sign of a new bubble? We are going to conduct a comprehensive long-term analysis of Meta Platforms. We'll cover the current strength of their 98% ad revenue engine, the sheer scale of their AI infrastructure build-out, the real story behind the Q3 earnings tax charge, the major risks and rewards, and finally, my personal investment thesis for the next 3 to 5 years. This is for the long-term investor, the one who looks past the quarterly noise. If you want to understand how Meta is attempting to pivot from a social media giant to an AI powerhouse, you are in the right place. Before we dive in, please remember this is crucial. This is Zalwora, and this content is for educational and informational purposes only. It is not financial or investment advice. You must always conduct your own research, consult with a qualified financial professional, and consider your own risk tolerance before making any investment decisions. Now, let's set the stage with the current market context for Meta Platforms as of November 2025. As of November 2025, Meta stock is hovering around the $600 level, a sharp pullback after their Q3 earnings report. Why? The market was spooked by the higher capital expenditure guidance. Meta raised its full year 2025 CapEx guidance to $70 to $72 billion and signaled an even larger spend in 2026. This spooked many, causing the dip. But here's the fascinating detail. S&P 500 tech firms with high CapEx as a percentage of cash flow have returned an average of over 45% in 2025. The market is ultimately rewarding the big spenders who are building the future. Meta's decision to spend big, despite the short-term margin hit, is a vote of confidence in their AI future. It's a conviction bet, and we are here to dissect it. So settle in, grab a coffee, and let's dive into the core of Meta Platforms, the business that's funding this massive AI dream. Let's start with a quick history lesson. From a dorm room in 2004 to a global behemoth, Facebook's journey has been one of relentless acquisition and pivots. The key moves? The acquisitions of Instagram and WhatsApp. These weren't just social platforms, they were the engines that grew Meta's user base to a staggering 3.96 billion monthly active users in Q3 2025. That's almost half the planet. The 2021 rebrand to Meta Platforms marked a major pivot to the metaverse. And yes, the Reality Labs division has been bleeding money, with losses widening to $4.4 billion in Q3 2025. But now the story has pivoted again. The core growth driver is no longer just the metaverse, but artificial intelligence. Let's break down the business into its core segments. Segment 1, Family of Apps, or FOA. This is the powerhouse. It includes Facebook, Instagram, WhatsApp, and Messenger. Crucially, it generates 98% of Meta's revenue entirely from advertising. In Q3 2025, FOA revenue hit an incredible $50.3 billion, a 26% jump year over year. This growth is powered by a 12% rise in ad impressions. The machine is running efficiently. Segment 2, Reality Labs, RL. This is the future bet. Hardware like the Quest VR headsets. It's only 2% of revenue, but it's where key future diversification lies. The high R&D spend here is what the market worries about. Other bets. Don't forget the emerging areas. Threads, the competitor to X, now boasts over 500 million users. That's a massive growth story in itself. We also have the Llama models, Meta's open source AI models, paving the way for enterprise AI services. So, what's Meta's position in the market? Simple: dominance in digital advertising. They hold roughly a 20% global share, competing directly with Google and Amazon. User engagement is phenomenal: 3.29 billion daily active people in Q3. That's an economic moat the size of an ocean. Switching costs for advertisers and users are incredibly high. While the stock is up roughly 60% from its 2022 lows, volatility persists, largely due to regulatory scrutiny, particularly around data privacy in places like the EU. Now for the leadership and vision. This is where the story gets really interesting. CEO Mark Zuckerberg has been explicit about his new focus: achieving artificial general intelligence, or AGI, by 2030. He's aiming for machines smarter than humans. This is a massive, ambitious goal. His recent move? A $30 billion bond sale. This isn't for fun. It's a clear signal to the market that he is absolutely committed to funding the necessary AI infrastructure without diluting shareholder value by issuing new stock. Let's put this spending into perspective by looking at the competitive landscape. Is Meta spending too aggressive? Consider this. Google Alphabet has spent about $49 billion on CapEx so far in 2025. Amazon? A massive $75 billion. Meta's aggressive CapEx is not an outlier. It's the price of admission to lead the AI infrastructure race. They are positioning themselves to be a leader, but they face huge challenges from alliances between OpenAI and Apple. We are seeing a new kind of arms race, a race to build the factories of the future. The data centers, the compute power. This context is crucial because it leads us directly into the deep dive on the financials. How does a company with this kind of capital commitment perform? We'll dissect the Q3 earnings, the tax charge that made headlines, and the valuation metrics that tell you if Meta is cheap or expensive right now. Welcome back. This section is the meat and potatoes. We're going to dissect the Q3 2025 earnings report. The headlines were confusing, so let's get clear on the numbers. Revenue. The headline here is pure strength. Meta reported $51.24 billion, a fantastic 26% growth year over year, and it beat Wall Street estimates. Breaking it down, 98% from ads at $50.3 billion. The remaining 2%, almost a billion, came from Reality Labs and other services. Net income. This is where the confusion came in. The reported net income was only $2.71 billion, which looks terrible, an 83% drop. But this is key. That drop was almost entirely due to a $15.9 billion one-time non-cash tax charge related to an IRS settlement. Expenses. Total expenses rose to $30.7 billion, a 32% year-over-year increase. This rise is the reason for the stock drop. It's driven by the massive AI R&D spend and a growing headcount of around 82,000 employees. Guidance. Management set the Q4 revenue range at $56 to $59 billion. More importantly, the full year 2025 CapEx was raised to $70 to $72 billion, signaling a notably larger spend in 2026. This is the source of the market's jitters. Revenue mix analysis. The 98% ad reliance is a double-edged sword. It's highly profitable, but it makes Meta vulnerable to privacy changes, like Apple's app tracking transparency. The push to grow the others segment, AI services, hardware, from 2% to something substantial is critical for long-term resilience. Let's visualize the key metrics. This is your scorecard for the company's performance. Total revenue $40.59 billion to $51.24 billion, a solid plus 26%. Ad revenue $39.94 billion to $50.30 billion, also plus 26%. The core business is firing. Operating margin dropped from 43% to 40%, mostly due to the one-time tax charge and the expense increase. Free cash flow, or FCF, dipped from $18 billion to $15 billion, a 17% drop. But this is a direct result of the rising CapEx. They are choosing to invest rather than hoard cash. CapEx, up from $9 billion to $11 billion in the quarter, a 22% increase. This is the indicator of their AI ambition. Valuation metrics. Is the stock cheap? Meta's forward PE ratio is sitting around 25x. This is below the Magnificent 7 average of around 30x. On a forward earnings basis, it looks more reasonably priced than its peers. The EV/EBITDA is around 15x. By many traditional metrics, especially after the post-earnings dip, Meta is looking slightly undervalued. Analyst consensus is overwhelmingly a buy rating with an average target of around $650. However, the spending concerns are the single biggest cap on that upside. Investors are worried about a repeat of the Reality Labs overspending. Added points on financial strength. Balance sheet. Meta is sitting on $70 billion in cash reserves and has relatively low debt even after the bond sale. They can afford this investment without breaking the bank or diluting shareholders. Profitability trends. The ad efficiency is actually improving due to AI. Personalized ads powered by Meta's models are boosting return on investment for advertisers by 20 to 30%. AI is feeding the ad business. The economic moat. The combination of network effects, billions of users, and their enormous data advantage makes their moat incredibly wide. This is a fortress business. This massive financial power is what allows them to make the big bet we're about to discuss, the unprecedented investment in AI infrastructure. Get ready, because the numbers here are mind-boggling. We are talking about the largest private CapEx commitment in history. This is the core of the Zalwora thesis. The market is focusing on the short-term margin hit, but you need to focus on the scale of the investment. Meta has committed an estimated $600 billion to the US by 2028 for AI infrastructure, jobs, and technology. This is staggering. It's been called the largest private capital expenditure in history. The market got spooked, but this post argues it's productive spending. It's like criticizing Henry Ford for building huge upfront factories in the early 1900s. You have to build the future before you can profit from it. So, where is this money actually going? It's not just a big number, it's physical infrastructure. They are building massive hyperscale centers. For example, a $10 billion plus project in Louisiana, a 4 million square foot facility powered by renewables, and another 1.5 billion plus gigawatt scale center in El Paso, Texas, launching around 2028. They have over 20 new centers planned, and they are deep in partnership with NVIDIA to secure the cutting-edge GPUs needed to run Llama 4 and 5. We mentioned the $30 billion bond sale, but they also secured an enormous $27 billion financing agreement with Blue Owl Capital just for the Louisiana site. They are using every financial tool available to fund this build-out. This build-out is creating AI factories, infrastructure for real-time processing that will power everything from improved personalized ads to the next generation of autonomous vehicles and even robo-surgeries. Why this scale? The goal is diversification. Moving beyond the volatile ad business into AI services, cloud computing, enterprise tools, and advanced Llama model subscriptions. The post's key point: ads plus AI infrastructure equals synergy. The massive computing power built for Llama and AGI will also make their core ad algorithms smarter, boosting ROI for advertisers even further. Let's look at the industry context. This is not happening in a vacuum. The AI data center boom is real. Big tech CapEx is projected to hit an astounding $370 billion in 2025. Meta's spend is aggressive, but it's aligned with rivals like Amazon and Microsoft, who had a combined Q3 CapEx of around $112 billion. AI is power hungry. Meta is heavily focused on using renewables and forming partnerships even with nuclear energy firms to mitigate the risk of rising energy costs. This is a critical operational risk. This is the most important part for investors. This is not a short term trade. Expect significant monetization in 3 to 5 years as AI subscriptions, enterprise tools, and deeper metaverse integration finally come online. Meta is taking a short term financial hit to cement a long term, multi decade lead in the AI infrastructure race. It's a brave move, and the market is still struggling to correctly price a move of this magnitude. But with great ambition comes great risk. In the next section, we look at the potential pitfalls, regulatory headaches, and the ultimate risk reward trade off. As a long term investor, you must weigh the risks just as carefully as the rewards. Let's look at the dark side of this AI bet. Risk 1: high capex and margin dilution. The 70 billion plus spent in 2025 and the promise of even more in 2026 is the core risk. If the AI hype bursts or if Meta fails to execute on the monetization, these massive investments will dilute margins for years. The 17% stock drop post earnings was the market pricing in this exact fear. Risk 2: regulatory headaches. Antitrust probes, data privacy fines, and new legislation like the EU AI Act could severely hamper Meta's ability to leverage its data advantage. Plus, geopolitical risks like China banning US chips can directly impact their supply chain for building these AI factories. Risk 3: competition and macro. Google, Microsoft, and OpenAI are also innovating at lightning speed. Their advances could erode Meta's edge. Additionally, a macro recession would immediately cut into ad spend, their lifeblood, causing a possible 1 to 2 year sideways movement for the stock. Now let's go to the rewards. Why is this still a compelling investment? Reward 1: upside potential. AI unlocks new multi-trillion dollar industries, autonomous vehicles, personalized medicine, and enterprise AI tools. The 3-year risk reward calculation strongly favors the bulls. The cost of missing the upside is greater than the downside risk. 2. True diversification. If Meta successfully grows the other segment to 10 to 20% of total revenue by 2030 via AI tools, the business model becomes fundamentally more resilient. That's a game changer. 3. Analyst sentiment. Many analysts view the stock dip as an overreaction, creating a prime buying opportunity. Those 30% plus upside targets to 650 or more aren't a pipe dream if the monetization thesis plays out. Let's check the pulse of the community. On X and other platforms, the community is divided. Bears call the $600 billion spend wasteful. Bulls call it a visionary confidence signal from Zuckerberg. The CapEx is the commitment. Bubble risk? This is a fair question. Are we in an AI bubble? The difference between AI and the dot-com bubble is that the underlying demand is real. Estimates suggest 7 trillion is needed for data center infrastructure by 2030. Meta is simply positioning itself to capture that demand. So the volatility will continue, but the direction seems clear. The long-term trajectory is up, powered by what they are building right now. This brings us to the final, most important part, the investment thesis. How do you integrate all this information into a smart, actionable plan? My personal thesis for Zalwora is clear. Meta Platforms is a long-term buy for diversified growth via AI. The key is ignoring the short-term drops. That 17% dip post-earnings, that's noise. The underlying ad business is strong, and the conviction in AI is absolute. Back the vision. These are necessary spans for next decade dominance in AI-enabled industries. You have to be convinced in Mark Zuckerberg's vision to execute the AGI goal. If you are, The time to buy is now. Who should invest? This stock is best suited for growth-oriented investors with a 3 to 5 year horizon. Don't invest money you need next month. For a balanced portfolio, a 5 to 10% allocation is a prudent amount to balance risk and potential reward. Monitor the Q4 earnings report expected in late January 2026. Pay close attention to any updates on the 2026 CapEx and expense guidance. Use market dips, like the recent 17% drop, to accumulate. Volatility is your friend if you believe in the long-term thesis. In conclusion, Meta isn't just betting on AI. It is literally building the physical and digital infrastructure that will define the future of the internet. Thank you so much for watching this deep dive into Meta platforms. I hope this gave you the insights you need to make a well-informed decision. If you found this analysis valuable, please like the video and most importantly, follow at Zalwora for more such insights. Your support helps me keep making these detailed analyses. Share your thoughts in the comments below. Are you a bull or a bear on Meta? Let me know your thesis. Thanks again for watching and I'll see you in the next analysis.